Business valuation for conversion from C to S corporation. When a C corporation makes the decision to change its legal structure to that of an S corporation, there are a few different valuation considerations that must be taken into consideration. These concerns may result in serious tax repercussions for the corporation as well as for the owners of the corporation. During the process of conversion, there are a number of key valuation concerns that need to be addressed, including the following. Built-in gains tax. A C corporation that converts to an S corporation is liable to a built-in gains tax on any appreciated assets that were held by the corporation at the time of the conversion. This tax applies only to assets that were owned by the corporation and not to assets that were acquired after the conversion. This tax is levied on the corporation, and its calculation is based on the disparity between the asset's current fair market value and its adjusted basis. The cost of the asset, plus any improvements or depreciation that have been made, is what makes up the adjusted basis in most cases. The corporation may be required to pay a tax of up to 21% on the difference between the fair market value of an appreciated asset and its adjusted basis if the fair market value of the assets is greater than its adjusted basis. Prior to the conversion, the corporation could be required to have an appraisal of its assets in order to avoid paying this tax. Valuation of shares. If a C corporation decides to convert into an S corporation, there is a possibility that the value of the corporation's shares will shift. The shareholders' potential tax liabilities as well as their ownership percentages may be impacted as a result of this. Prior to the conversion, the corporation could be required to get an appraisal done on its shares in order to ascertain what its current value is on the market. This is of utmost significance in the event that the company in question has more than one category of shares, as the value of each category may need to be ascertained independently. Intangible assets. It can be challenging to assign a monetary value to intangible assets such as patents, trademarks, and copyrights. On the other hand, the value of the company as a whole may be significantly influenced by these assets. Prior to the conversion, the corporation might need to have these assets evaluated so that it can identify what their true value is on the market. This is significant because the value of a corporation's intangible assets has the potential to influence both the corporation's tax burden and the ownership percentages of its shareholders. Deferred tax liabilities. When converting from a C corporation to an S corporation, you need to take into account whether or not the C corporation has any deferred tax liabilities. Differences between the book basis and the tax basis of the corporation's assets and liabilities might give rise to these liabilities for the corporation. The value of the assets or obligations is determined by the corporation's accounting records as referred to as the book basis, whereas the value of the assets or liabilities as determined for tax reasons is referred to as the tax basis. Prior to the conversion, the corporation may be required to have its deferred tax liabilities evaluated in order to establish the impact the conversion would have on its tax liability. Goodwill. Before the conversion, it is possible that the corporation's goodwill will need to be evaluated if it possesses any. The value of a corporation's goodwill equals the difference between the value of its assets and the value of its liabilities. There is a direct correlation between the value of a company's goodwill and the overall value of the company. The worth of a company's goodwill is not always easy to ascertain, particularly if it is connected to intangible assets such as customer loyalty or brand recognition. In order to identify the true value of the corporation's goodwill prior to the conversion, the corporation may need to have an appraisal performed on it. This is significant because the value of the corporation's goodwill has the potential to alter both the corporation's tax burden and the ownership percentages of the shareholders. Capitalization rates. A capitalization rate is used to assess the current value of an asset's future income streams. This is done while valuing a corporation's assets, such as real estate or intangible assets. The expected rate of return on investment in the asset is a statistic that is referred to as the capitalization rate. In order to ensure that the values of the business's assets are appropriately reflected after the conversion, it is possible that the corporation will need to have its capitalization rates decided beforehand. Agreements with shareholders. It is possible that existing shareholder agreements may need to be revised or rewritten after the conversion in order to take into account the modifications to the ownership structure of the organization. The rights and responsibilities of shareholders are often spelled out in shareholder agreements. These provisions can include voting rights, dividend payments, and buyout provisions. It is possible that these agreements will need to be updated in order to take into account alterations in the shareholders' ownership percentages and the tax status of the organization. Employee stock ownership plans, ESOPs. Changing from a C corporation to an S corporation can have substantial repercussions for the tax treatment of employee stock ownership plans, ESOPs, assuming the firm already has an ESOP in place. Depending on the tax status of the corporation, ESOPs may be subject to a separate set of tax regulations. In order to guarantee that the employee stock ownership plan, ESOP, is appropriately organized for the corporation's transition into an S corporation, it is possible that the ESOP will need to be evaluated by a competent professional. State taxes. Taxes levied by the state. It's possible that, in addition to paying federal taxes, a corporation that changes its status from a C corporation to an S corporation will also have to pay taxes levied by the state. The process of conversion may be affected by the various tax laws and regulations that are specific to each state. In order to determine the state tax ramifications of the conversion, the corporation may find it necessary to speak with an experienced tax specialist. Conclusion. In general, the valuation difficulties during conversion from a C corporation to an S corporation are difficult to navigate and demand thoughtful analysis. To ensure that all valuation issues are appropriately addressed and that the conversion is structured in a way that reduces tax obligations and optimizes shareholder value, it is imperative that the corporation seek the guidance of skilled specialists, such as accountants and tax attorneys. Thanks for watching.